Investing strategies during high interest rate periods. In the world of finance, interest rates play a pivotal role in shaping the investment landscape. During high interest rate periods, investors face unique challenges and opportunities. These times can be both a curse and a blessing, depending on how you approach your investment strategy. In this video, we'll explore some investing strategies tailored for high interest rate environments. Understanding high interest rate periods. Before diving into investment strategies, it's crucial to understand what high interest rate periods mean for the economy and investors. High interest rates generally occur when central banks, like the Reserve Bank of India, increase the benchmark interest rate, known as the repo rate. This move is often employed to combat inflation, stabilize the currency, or cool down an overheated economy. Let's look at some key aspects to consider. Bond prices and yields. When interest rates rise, prices of bonds with longer time left for maturity typically fall. This is because existing bonds with lower yields become less attractive compared to newly issued bonds with higher yields. Investors holding bonds may see the immediate market value of their investments decline, but at the same time, they'll benefit from higher yields on new bonds. Equity market impact. High interest rates can have mixed effects on the stock market. On one hand, they can be perceived as a sign of a strong and a buoyant economy, which can be positive for corporate earnings and, in turn, stock prices. But, on the other hand, higher interest rates can increase borrowing costs for businesses and consumers, potentially slowing down future economic growth. Senior citizens who are dependent on interest income from fixed deposits. Though, savers typically benefit from high interest rates, as they can earn more on their fixed deposits, but they must also remember that what is more important is the real purchasing power of their money. An 8% interest income with 9% inflation is far less valuable than a 6% interest income with 5% inflation, as the real return is positive for savers in the second scenario, even if they are earning supposedly lesser percentage in interest income. Real estate. The real estate market can be negatively impacted by high interest rates. Mortgage rates often rise, making it more expensive for people to buy homes. This can put downward pressure on property prices and potentially impact real estate investments. Given these dynamics, let's discuss some safe investing strategies to consider during high interest rate periods. Diversify across asset classes. Proper asset allocation remains the foundation of sound and prudent investing. A diversified portfolio that includes a proper mix of asset classes, as per individuals' financial goals and volatility tolerance, such as stocks, bonds, real estate, commodities, etc., can help investors weather the potential impact of interest rate increases on specific investments. These days multi-asset funds are available with almost all mutual fund houses in India, and they may be considered for investment, especially during periods of high interest rates with high uncertainties. In a high interest rate environment, consider allocating more of your portfolio to assets that tend to perform well under these conditions, such as high credit quality liquid funds, short duration debt funds, and arbitrage funds. At the same time, maintain a balanced exposure to equities, as they can still offer growth potential, especially if the economy remains strong. Defensive sectors. During high interest rate periods, certain sectors of the stock market tend to perform better than others. Defensive sectors, such as healthcare, consumer staples, and utilities, are known for their resilience in economic downturns and higher interest rate environments. These sectors offer products and services that people consistently need, making them less sensitive to changes in interest rates. Investing in defensive stocks which have consistently been able to grow or maintain their market share, increase their sales along with earnings per share, and available at reasonable valuations can provide stability to investors' portfolio. Companies in these industries tend to have more predictable cash flows and dividend payments, which can be attractive to investors seeking safety and income. Maintain an emergency fund. In uncertain economic environments with rising interest rates, it's wise to ensure that investors have a sufficient emergency fund in place. This fund, typically consisting of highly liquid assets, should cover at least 3 to 6 months' worth of living expenses. The emergency fund acts as a financial safety net in case unexpected expenses arise or you face a temporary loss of income. It can help you avoid tapping into your investments during market downturns, which is essential for preserving your long-term financial security. Active portfolio management. In high interest rate periods, maintaining a passive buy and hold investment strategy may not be as effective as in more stable times. Active portfolio management involves periodically monitoring and adjusting your investments to respond to changing market conditions. Investors may consider tactical asset allocation during these times where they may rebalance portfolio as per a defined asset allocation or market valuations. Active management allows you to adapt your portfolio to evolving economic conditions, potentially reducing risks and capturing opportunities. Keep a long-term perspective. Finally, remember that investing is a long-term endeavor. While high interest rate periods may introduce short-term volatility, maintaining a long-term perspective is key. Over the long run, Indian markets have shown a consistent trend of growth, even amidst rising interest rates. Stay focused on your financial goals and resist the urge to make impulsive decisions based on short-term market movements. Stick to your strategy and trust that, over time, it will help you achieve your objectives. In conclusion, high interest rate periods present both challenges and opportunities for investors. By diversifying across asset classes, focusing on short-duration high credit quality debt funds, considering consumption-driven sectors, maintaining an emergency fund, engaging in active portfolio management and maintaining a long-term perspective can help develop a safe investing strategy that is well-suited to thrive in this environment. Remember that the key to successful investing during high interest rate periods is adaptability, prudence, and a commitment to your long-term financial objectives. For a one-to-one discussion with a highly experienced and knowledgeable finance professional at EA Capital, who always keep your interests ahead of everything and work in a completely transparent manner, you can write to us at info@eacapital.in, and one of our team members will get in touch with you. Stay tuned for next video.